Accounting A Screencast by Lindsay Kilgour. What is earnings management? It is the manipulation and distortion of companies' financial earnings, either directly or through indirect accounting methods. Earnings management also allows for income smoothing. So instead of having large amounts of profit or loss that fluctuates, it is managed to a consistent level over a period of time. An example of earnings management is Enron, who sustained its financial position by institutionalized, systemic, and creatively planned accounting fraud. In late 2001, the energy giant filed for bankruptcy. So why does earnings management occur, here you say? This type of earnings management occurs so preparers can create and manipulate financial statements to suit their own purposes. When the stakes are high and there are considerable incentives, including both monetary, through increased remuneration, and non-monetary, such as shared bonus schemes. By misrepresenting the figures, executives can not only obtain higher profits, allowing them to increase their bonuses, but it can also project a more positive image of themselves and the company to various stakeholders. Example 1. Some accruals can be subject to earnings management, including depreciation and inventory. For example, when it comes to the depreciation of assets, switching to the diminishing balance method from weighted average allows the company to write off a larger value of assets in the early years, which can reduce earnings and consequently reduce tax liabilities. Example 2. Enron booked revenues before they had been earned and recorded expenses when it was beneficial to them. The primary motivations for Enron's accounting and financial transactions were to keep reported income and reported cash flow up, asset values inflated, liabilities off the books. Whereas under the matching principle, when you record revenue, you should also record the expenses directly related to the revenue at the same time. Thus, if there is a cause and effect relationship between revenue and expenses, they should be recorded in the same accounting period. Why is earnings management reprehensible? Earnings management is not fair to users. They involve an unjust exercise of power, and they tend to weaken the authority of regulators. Investors can lose a substantial amount of money, and employees can lose their jobs. Money from shares when the manipulation comes to a head. Hence, the intention is to deceive the recipients of financial statements, and can therefore, from an ethical perspective, be regarded as morally reprehensible.
Oh.